It's been almost exactly 5 months since Vladimir Putin invaded Ukraine with Russian forces, but now the world seems to be concerned with another war, the war on inflation. While the war on inflation has certainly weighed down the price of gold. Earlier this year, gold broke very briefly above $2,000 an ounce, but it's since come back down. Today we're speaking, and it's just above $1,700 an ounce USD. The question is, will this trend continue? And what are the most important variables driving the gold price today? Well, there's only two of them, the real interest rate and the US dollar, according to our next guest, Alain Corbani. He is the portfolio manager of Global Gold and Precious Fund and the head of mining at Finance SA. And he is here to break down exactly what will drive gold into the remainder of the year. Alain, welcome back to the show.
Good morning, David. It's good to be with you.
You've synthesized the program for us very well. Peak inflation, peak interest rates, and peak US dollar. We're going to be talking about all these three things because you said offline to me that we have reached peak inflation, peak interest rates, and peak US dollar. And this is very important for the gold price. But before we talk about those variables, let's talk about what happened. In your words, what happened to the gold price over the last 5 months? Why has it been coming down?
The price of gold has consolidated over the last 3 months because of two things. First, deceleration in inflation expectations. I know everybody's talking about inflation and the last CPI was horrible, but the reality is that the markets have been anticipating a lower inflation down the road, and whether we're talking about the 2, 5, or 10-year horizon. And at the same time, the Fed has kept a momentum of tightening. So higher nominal rates and lower inflation expectations led to higher real interest rates. And at the same time, the US dollar didn't help us, and it did affect the price of gold on the downside.
Okay, I want to talk about that relationship in a bit more detail in just a bit. But first, let's go back to the war in Ukraine. I remember back in late February when the war broke out, analysts were commenting on the geopolitical risk premium that the war brought to the price of gold. You'll recall that in late January, before February, before the war in Ukraine happened, actually all throughout February, the gold price was already rising. So maybe the markets were already anticipating some sort of conflict, either a hot conflict or a more diplomatic conflict, if you want to call it that. The point is, as of January 31st, the gold price was around $1,800 an ounce. Right after the outbreak of the war, 1 week after the invasion of Ukraine, the gold price broke above $2,000 an ounce, and then it came right back down and hovered around an area between $1,900 and $2,000 an ounce. And then some people were concerned that perhaps, all else being equal, if, let's say, the dollar didn't move, let's say real interest rates didn't move, let's say a resolution were to happen in Ukraine, let's say things calmed down, the gold price would come back down because there's no longer a risk of war. Do you think that's what happened?
No. I think that the war in Ukraine was another element that really put some headwinds to a bulwark for gold. What really happened is that remember, the Fed was already talking about tapering. The Fed was already talking about potentially after tapering increasing interest rates. So gold was on a path for a consolidation. This was meant to happen. The war in Ukraine heightened the risk of inflation, heightened the risk of supply chains, heightened the risk of demand dropping, and this has just only exacerbated what was really in the making. So Ukraine has only exacerbated what I think was our scenario, which was despite tapering and despite the willingness to increase rates, the central banks wouldn't be able to achieve that objective.
I see. Okay, so hawkish central bank policies have played a major role. All right, let's get to the core of our presentation today, of our discussion, which is the relationship between gold and real interest rates and also the US dollar. So let's recap. You and I have talked about this before. You're famous in our show for being the real interest rate guru. You've explained this relationship very well. Let's recap for the audience. The real interest rate and gold have very strong inverse relationship historically. Actually, if you plot it over the last 5 years, I think the correlation is 95%, the R coefficient. Yes. And people think of gold as an inflation hedge, but you've correctly corrected me actually on the show before. You've said gold is really a hedge against real interest rates because gold is a non-yielding asset. When real interest rates are high, people flock to fixed income assets, safe haven assets like CDs, treasuries, bonds, high grade corporate debt, and so on. And when real interest rates are low, those assets don't yield as much, so people go back to gold. So that's the relationship. Can you expand on that?
Actually, this is exactly what happened. So remember, I just mentioned a few minutes ago that we have reached peak inflation, we have reached peak nominal rates, and we have reached a peak US currency. Let's get back to those three metrics.
Yes.
The first one, peak inflation. Why do we think that we have reached peak inflation? We have reached peak inflation because we are heading towards maybe a recession, and we cannot qualify the severity of a very potential risk of recession. And if it's not a recession, it might be stagflation. And if it's not stagflation, it might be stagnation. But the reality is that, and the numbers are showing it, if you look at the statistics that are published by the Fed of Cleveland or the Fed of Atlanta, or if you look at the break-even rates on 2, 5, and 10 years, the reality is those numbers are telling you that we have reached peak inflation. The expectations for inflation down the road from 2 to 5 to 10 years are going down and have been going down since the months of March. So remember this. Inflation, even though everybody's talking about inflation, everybody's talking about hyperinflation, everybody was talking about inflation on the good side, and now everybody is talking about inflation on the services side. And this whole thing makes it like it has become the main danger for the economy and the central banks that they have to fight. And this is another subject. But the reality is that inflation has been decelerating for the last 3 months. Well, number one.
Okay. Number one. All right.
When we enter a slowdown of an economy, demand slows down. If demand comes down, well, you will definitely have less pressure on prices. And this is exactly what we have been observing. And to validate this point, if you look at the first quarter GDP that the US had to publish, it was negative by more than 1%. And if you look at what's going to happen in the second quarter for the US economy, it's also going to contract because the latest statistics show that most probably the second quarter will be down another 1.5%. This is again based on the latest statistics of the Federal Reserve of Atlanta. So whether we are technically in a recession or not, I'm not going to discuss this. But the reality is that if we are in a recession, we most probably have already 2 negative quarters. That's number one. If you have a recession, you have less pressure on prices. This is obvious. And this is exactly what has been happening. The markets have been telling us for the last 3 years that we are entering a dangerous contraction in the economy, and that will lead to less pressure on prices. And this is why the final point is you will have, so not only we have reached the peak inflation, but also we have reached a peak US dollar, and I will get to that.
Yes.
But in a recession, remember, there has never been a recession with higher nominal rates. Nominal rates go down in a recession.
Okay.
Nominal rates don't go up.
Okay.
So that's why I'm saying peak nominal rates. That's why I'm saying peak inflation. And the logic of those two components is a lower currency. Because the only way to help an economy grow is to have a weaker currency.
Okay.
Today, the United States, and I will let you ask me more questions, David, but today the United States need a strong dollar to fight inflation. But the more that inflation risk is going to weaken, the more Treasury or the Fed will be inclined to allow the US dollar to weaken again in order to get the economy back on its feet.
Okay, excellent. That's an excellent summary, Alain. Peak inflation, peak USD, peak rates. So let's talk about each of those. Number one, peak inflation. So the CPI number came out last week in the US. Headline CPI was 9.1%. I believe the euro area is 8.6%. But in any case, 41-year highs for a lot of different regions around the world. We're not talking about Turkey or Venezuela. Those are double digits. It's a different story. But in the West, high single-digit government numbers. I stress government numbers because it could be higher.
David, you're right. But David, the CPI is a lagging indicator.
Right.
So we can discuss about the CPI, but the reality is that it won't tell us what is the trend in the future down the road.
So you think it's going to plateau. Now let's talk about that, because you are right, actually. If you look at most recessions in the past, almost all recessions, they've always been accompanied by either deflation or disinflation, meaning very low inflation. Very rarely do we have. Obviously, the 1970s was an outlier. We had some stagflationary periods, but that was a supply shock problem. And that's my question to you, Alain. Yes, you're right. Usually in a recession, you have lower aggregate demand to bring down prices. But remember what happened in the 70s, late 70s. Remember what happened in 2020, 2 years ago. We had a supply shock issue. So less demand, but also much, much less supply. Could we have that again this time? That could push up inflation, right?
It could, but the main risk for us today is the recession. This is obviously something we have to deal with. Maybe or not, it was orchestrated. We can discuss it by the central banks, but the fact is that central banks today have one enemy in mind, and it's inflation. Rightfully or wrongfully, this is not the subject, but they have this enemy, and they are fighting it by increasing rates, and they are going to continue increasing rates. But we're talking about Fed fund rates. We're not talking about what the markets are telling us, and the markets are telling us is that the 3.8% nominal Fed fund rates for 2023 will not be achievable. Okay. So will there be another supply shock? Maybe, but frankly, don't you think that we've had all the major nightmare scenarios that have already lined up against us? So
we just need a stronger COVID variant, Alain. That's what we need. Wait for a new COVID variant to come out.
It's not because it's funny. When you are at the bottom of the hole, you think that you can go lower, but actually you cannot go lower. That's the bottom, and this is, I think, what we have reached.
All right. So peak inflation. All right. So let's talk about peak rates first. So peak rates, very interesting. So your argument is actually that in a recession, rates go down. Can you explain why?
Always. Well, rates go down because there's nobody that is going to accept to pay a premium when everybody's either in a weaker financial position or with a labor market that is and will weaken to some extent, and probably much less than in the previous recessions. But you need lower rates to trigger demand. Without lower rates, you won't trigger demand, and we need demand to create growth. So this is why rates are going to go down. This is why they keep going down. They kept going down, and they went down in each recession.
I know we're not. Sorry, please continue.
No, it cannot be the other way around. It cannot be. If you want to make it worse, you can increase rates. And some people were referring to Paul Volcker in the early 80s, but they did, America or Europe, we didn't have a 100 or a 120% debt to GDP.
Yes.
We were not in a position that we are not today in a position that allows us any margin of error. There is no way we can have Fed fund rates reaching the level of core PCEs or CPIs. This is impossible. The machine will not accept it. It's going to break way before we get there. And this is exactly what has been happening. David, look at what the equity markets have been, how they have been behaving. And the bond markets, they have been telling us, you know what? This is not going to work. And indeed, it's not going to work because we have too much debt. And we cannot afford having high rates on a very explosive debt to GDP level.
Let's talk about number 3 now, peak US dollar. So yes, your arguments make sense. With a lower nominal rate and potential slowdown in the US, we should see a weaker US dollar. But I'm just going to throw this argument, Alain. Please address it if you can. What about relative to other currencies? Suppose the euro area also faces a recession, and relative to the US is even weaker. Wouldn't capital still flow to the US?
That your question is very pertinent, because we have a strong US dollar because it's the perfect safe haven asset number 1. It's a counter-cyclical asset number 2. It's the spread, different spread between Europe and US is wide enough to still give the USD the advantage. But also, you're right, Europe hasn't been helping, and the European Central Bank, the ECB, which has only one mandate. The ECB doesn't have 2 mandates like the Fed. There's the ECB has only one mandate, is to fight inflation. It's price stability. And they are not capable to increase rates.
Why?
They are now discussing, you're right, they are only now discussing about the potential to increase their rates from 25 basis points to 50 basis points.
Why are they not capable?
They are too afraid of to trigger the recession, which is at their door. So the little growth that Europe has it needs to be protected as much as possible, and that's why the BCE is freaking out and is completely focusing on inflation, but cannot do anything about inflation because it's afraid to trigger the next recession. So yes, that's why we have a strong US dollar. But tell me whatever you want. The reality is, I repeat it, only a weaker currency helps you create growth. That's it. And I if I have to bet on one economy, I will bet on the US economy. And the US will make sure that their currency is properly positioned to help the economy grow again. Whether Europe or Japan or Russia or India or China don't play the game.
Yeah, okay, interesting. Okay, the strong U.S. dollar. By the way, let's recap since we're talking about the euro. Let's recap why the U.S. dollar reached parity with the euro for the first time since 2002. What happened in the last couple of weeks to months?
Well, first of all,
was it just rising interest rates from the Fed?
It was rising interest rates and the BCE not being able to show, to demonstrate that it can and has the ability to fight the number one or number two risk, which is inflation. So a completely paralyzed BCE and a Fed that is staying on track. And when things get worse in Europe, well, things usually get a little better in the US. And this is exactly what happened. You add a dose of speculation, and this is what you get.
Okay, so let's finish up, Alain, and talk about the real interest rate, which is ultimately one of the variables most important for the gold price. The real interest rate is the nominal rate minus the inflation rate. Now, we've talked about both these variables already. So let's start with your projection for both these variables and then ultimately where the real interest rate is going to go. So nominal rate, the 10-year yield in the U.S. is at 2.993% as of this morning, Eastern time. Now, the inflation rate we've discussed, 9.1% headline CPI with the latest number. You said that was a lagging indicator. And ultimately, the real interest rate, what we're concerned about, has been steadily trending up since the beginning of this year, Alain. And then now it's above. People were talking about a negative real interest rate for a long time, and it has been real. But ever since May, I'm looking at the chart. Ever since May, Alain, it's been positive. So the question is, what will move the most, nominal rates or inflation? And ultimately, what will the real interest rate do from here?
This is the key question, and we will try to remain as simple as possible. We are entering a period of either slow growth or negative growth. This will take nominal rates down. This will take inflation down.
Yes.
The only way to fight inflation effectively is a recession. And the Fed knows it very well. So they orchestrated this slowing or next recession, and they will reach their objective of lower inflation. That should, again, lead us to lower rates, nominal rates, and lower inflation. Now, the question that you asked me is, where do I see real rates?
Which will move down more, basically? You said both will move down, nominal rates and inflation. Which will go down more?
If we have a very hard landing, we might enter deflation.
Really?
If it's a hard landing, we might enter deflation. We wouldn't be talking about, a one-digit or 3-point inflation numbers. We could be talking about deflation if it's a hard landing. And I can tell you that the Fed doesn't want a hard landing. So the Fed will do everything to avoid a hard landing. The Fed will do everything to slow down the economy, to fight this inflation, and will do everything to avoid a hard landing. So there will be this balance of talent between making sure that this recession that is coming will impact demand, will slow down inflation without triggering deflation, because worse than inflation is deflation. So
Yes.
if there is one disease that you don't want to have to fight is deflation. So and in a deflation environment, I can tell you that gold does very well too. So I don't have a crystal ball, but I'm trying to walk down this fine line, and the fine line would tell me that nominal rates will have peaked, that inflation will go down, because the recession will trigger a downward pressure on prices. And I can tell you that in these circumstances, the US dollar will weaken. And this is what we want. And today, yes, real rates have the highest negative correlation with the price of gold, followed by the US currency. But tactically speaking, it seems to me that a weaker dollar would impact in a very short time positively the price of gold. There has been too much speculation. It's a one-way trade long the US dollar. Well, it's overcrowded. This is not going to last.
That's my final question to you, Alain. And so to sum up, it sounds to me like you think that the inflation rate could fall down faster than the nominal rate, which would imply, if we take the equation, nominal rate minus inflation rate equals real interest rate, it means the real interest rate will stay above zero for the foreseeable future. That's your summary, right?
It's not impossible, but remember one thing, that the 10-year is at 3%, the 5-year is at 3%, the 20-year at 3.5%.
Yeah.
So the core PCE is at 4.5%. So do you really think that the Fed is going to sit down and watch the economy fall without? Exactly. So I think I think that let's not fine tune it, because we are not capable to do it. We don't know what's the different variables. But the reality is that if the trend for lower inflation and lower rate should marginally affect the price of gold, but the US currency will.
I'm just curious, Alain, do you not think the Fed will continue to raise rates this year? And whether or not that would impact the nominal 10-year. For example, the markets are pricing at a 100 basis point rate hike by the next meeting. Do you agree with that?
Of course not. Of course not. No. It's nonsensical. And the markets did react to that CPI, and a couple of hours later, they understood what it meant. And basically, it meant that inflation was higher than what the retail sales were showing, meaning, in a nutshell, that Americans were poorer than what they were. So, and this is why the equity markets went up, and this is why the bond market, the yields went slightly down. So the market is telling us, and has been telling us, David, let's not complicate things, that rates are going down from now on. And even though the Fed is always right, they can change their mind, and they have been changing their mind on a regular basis. So the Fed funds rates at 3.8% in 2023. Mark my word, this will never happen.
Wow. Okay. That's a very strong quote. I should have started with that, actually, but we had so many other things to discuss. You have so many strong opinions throughout this interview. I'm going to end on this then. Okay, so what is your gold price prediction? Basically, if you have the US dollar moving in one direction and suppose the real interest rate moves in another direction, which is a stronger long-term force, the dollar or the real interest rate, what will happen to gold?
I'm going to stick to my scenario, which is we're entering a period of very slow growth or no growth at all. And that means lower rates. That means a lower US currency to trigger the next phase of expansion. And for that to happen, in the meantime, we'll have a higher price of gold.
Is it marginally higher? Is it above 2,000? I mean, $1,700
Here is something that very few people know.
Yes.
Gold mines obviously have a very high correlation with the price of gold. Mm-hmm. And the leverage is much higher, so the volatility is much higher. But in a turnaround situation, which is the one I think we are observing today, any rebound in the price of gold will generate significant returns for the owners of gold mines. And let me explain it, because this is very important. Gold mines in a rebound market, they tend to do much better than the equity market in general. It takes less than 18 months for gold mines to recoup their losses on average, whereas it could take 5 and 10 years for the equity market to recoup its losses after a crisis. So I think, to answer your question, I think this is how I see it. Okay. I see for those gold mines a V-shaped recovery. This is what I see. And for that to happen, we need a higher price of gold. And I think that this gold price, it's not going to be 1,800 or 1,900. It's definitely should shoot above $2,000.
All right. Well, okay. Well, that was very thorough analysis on where you think gold is going to go. We'll talk more about miners next time. I know you are also an expert on mining stocks and how mining companies operate. So that should be an interesting discussion. But thank you for your macro overview today, Alain. I appreciate it.
My pleasure.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.